It's 3 a.m. on a random weekday, and somewhere between New York and London, a risk committee has just approved something most XRP holders never thought they'd see: a green light to buy XRP through a Wall Street ETF. While most people are asleep, charts closed, notifications off, money is quietly wiring its way into products with tickers like XRPC and GXRP. No Binance tutorials, no "how do I move this to a hardware wallet?" Just a line on a portfolio report. XRP exposure. Approved. At the same time, on the other side of the screen, something very different is happening. Whales are testing the market, dumping large blocks of XRP into the order books and watching to see who catches it. Price spikes down, social media panics, comment sections fill up with "it's over" and "told you so." And then, almost as quickly, XRP claws its way back toward that $2 line. So in this video, I want to pull those two threads together: ETFs at the top, whales at the bottom, and a market trying to decide whether $2 becomes a ceiling again, or the launchpad for a serious move toward 3. Because buy now if you can isn't about hype. It's about understanding who is really entering this market, who is quietly exiting, and what that tug of war means for anyone still trying to build a position before the next phase of this XRP story. For years, XRP sat in a strange category: huge community, clear payment use case, endless courtroom drama. But from the perspective of traditional finance, it was still just another awkward crypto asset. Hard to hold, hard to justify, and easy for compliance teams to say no to. That's the first thing that's changed. With the arrival of XRP spot ETFs, XRP has crossed an important line. It has gone from something you had to seek out on a crypto exchange to something that can sit inside a regulated investment product, custodied by a professional firm, traded with a ticker symbol, just like any stock or bond. What that does is remove friction. Pension funds, wealth managers, family offices, all the players who live inside the traditional system, can now gain XRP exposure without leaving their lane. No new accounts, no new tech, no debates about private keys. They can simply allocate to an ETF that tracks XRP and report it like any other asset in their portfolio. Is every institution suddenly piling in? Of course not. But the difference between "they can't touch it" and "they could buy it tomorrow if they wanted to" is huge. We're now living in the second world. The pipes exist. The decision becomes purely one of appetite and timing. Now, let's match that structural shift with what's happening on the chart. Recently, XRP has been fighting around the $2 area. That number isn't magical, but it's important. It's where a lot of people mentally separate cheap from expensive. It's where older holders remember previous failures to break higher. And it's where a lot of leveraged traders like to place their lines in the sand. We've already seen what happens when this level is tested. A wave of selling comes in, sometimes hundreds of millions of XRP changing hands in a short space of time. Price slams lower, liquidations fire. You get that familiar feeling in crypto. The stomach drop, the timeline full of red candles, and here we go again. But then something interesting happens. Instead of continuing straight down, XRP finds buyers, it stabilizes, it starts to grind back up. And suddenly that scary wick on the chart looks less like the end and more like a stress test. A moment where the market found out who was really willing to own XRP at those prices. That's the dynamic we need to pay attention to. Whale selling is not automatically bearish. What matters is who's there on the other side. If every big dump is met with silence, the price collapses and stays down. If those dumps are met with quiet but steady demand, the token structure changes hands from short-term speculators to longer-term holders. Think about the psychology. One person selling 10 million XRP because they're nervous about the next move is still just one person. 10,000 people each buying a small slice of that supply because they're planning to hold for years can completely change the market's backbone. You don't see those people shouting on social media. You see them in the way price refuses to stay down for long. From a technical perspective, the picture is simple. Below us, The $2 area is trying to flip from resistance into support. If XRP can hold that zone, respect it on dips, and keep closing above it, the market will start to treat it as a new floor rather than an old ceiling. Above us, there are obvious checkpoints, roughly 220, 250, and then the big psychological target that everyone keeps talking about, $3. None of these levels are guaranteed barriers or guaranteed magnets. They're simply places where human behavior tends to cluster. Traders take profits. Algorithms rebalance. New headlines get written. When people ask, is $3 XRP realistic? They often want a yes or no answer, but markets don't work like that. The better question is, under what conditions does $3 become a sensible, not crazy outcome? And right now, those conditions are starting to line up. You've got new ETF pipes that can, in theory, absorb large inflows over time. You've got a market structure that has already demonstrated it can take heavy selling and still recover. And you've got a broader macro environment where digital assets are increasingly treated as a legitimate part of a diversified portfolio. Put all of that together, and $3 stops being a wild fantasy number and starts looking like a step on a path. Not the end of the journey, but one milestone along it. But here's the part that often gets missed. ETFs and whales are the visible pieces. They create headlines and dramatic candles. The real story is quieter. It's about how XRP's role in the wider financial system is evolving. Every time a new regulated product launches, every time a bank or payment company experiments with XRP or related tech, the asset moves a little further away from its old stereotype as that controversial token, from that never-ending lawsuit. It starts to look more like infrastructure, a piece of plumbing, a rail that value can move across. Infrastructure assets behave differently from pure hype coins. They can still be volatile, especially in crypto, but their long-term trajectory is more connected to whether the rails they support actually get used. That's why big money cares about things like payment corridors, liquidity hubs, and on-demand settlement. They're not trying to flip a quick 10%. They're trying to understand what role an asset might play in a future system where more and more value is tokenized and moved digitally. So when you see an XRP ETF approved, think beyond the short-term price spike. Ask what it says about how regulators now view the asset. Ask what it means when risk teams, lawyers, and compliance officers have spent months reviewing it and still ended up with the word approved on their internal memo. That doesn't make XRP risk-free. Nothing in. Crypto is. But it does mean the conversation has shifted from we can't touch this to under these conditions, we will. Practically, what does all of this mean if you're watching this video and wondering whether you've already missed the move? First, it means understanding that FOMO is not a strategy. Buy now if you can is not an order. It's a reminder that markets offer windows. And those windows eventually close, one way or another. Sometimes they close because price runs away and never comes back to your dream entry. Sometimes they close because the thesis breaks and the asset never recovers. Your job isn't to chase every candle. It's to decide which windows are worth stepping through, based on your own risk, time horizon, and conviction. Second, it means zooming out. If your plan is to hold XRP or any other serious digital asset over a 5 to 10 year window, then the exact tick where you buy matters less than the quality of the story behind it. Are the rails getting stronger? Are the access points widening? Are more serious players entering the arena, not just retail flows and one-shot hype? Right now, the answer for XRP is that the rails are maturing. The access points just expanded via ETFs, and the mix of players is slowly broadening. That doesn't guarantee success, but it does mean the asset is no longer living in the same world. It was a few years ago. Finally, there's a more personal question. If XRP does move from here toward $3 and beyond, what kind of holder do you want to be? The person who bought in a panic because the thumbnail said last chance and then sold at the first red candle? The person who sat on the sidelines, convinced it was all going to zero, and then watched the story unfold without them? Or the person who took the time to understand the mechanics, ETFs, whales, levels, liquidity, and built a position that made sense for their life, not just for their emotions on one particular day. That's the real decision behind buy now if you can. It's not about trying to be cleverer than the market. It's about being clear with yourself. So as we head into this next phase of the XRP story, with ETFs live, whales still testing the depth of the pool, and that $2 line acting as the battleground, take a moment to step back from the noise. Look at the structure. Look at the direction of travel. Ask whether the risk, for you, is being in or being out. Because in markets like this, the difference between opportunity and regret is often just one thing. Whether you understood what was really changing while everyone else was still arguing over the last candle,